Hey everyone, welcome back to Corporate Decoder, the place where we dig through the jargon so you don't have to, trust me. After seeing this report, reading the Financial Times might seem like child's play. Today we're diving into a semi-annual report, so hold on tight because things are about to get wild. We're talking about investment trusts that dabble in international markets from Africa to Japan, and spoiler alert, not everyone had a stellar 6 months. Before we begin, if you find corporate speak confusing, come join our Discord server linked in the description for more in-depth explanations. This isn't just one company, it's a whole bunch of them, so we'll break down what we got here. This is the Commonwealth International Series Trust, and it's a certified shareholder report. It's like a progress report card for your investments, but instead of grades, we get dollars and cents. The reporting period is from November of last year to April of this year. To find out what's really going on, first we will scroll down to item 1 to inspect reports to stockholders. First up, we have the Africa Fund, because you always have to bet on the next big thing, right? This report tells shareholders how their investments in African companies performed during the reporting period, and includes hard numbers about fund costs in costs and percentages. For example, if you had a hypothetical $10,000 invested, the cost you'd pay as a percentage is just 1.75%. So you would have paid $87 in this reporting period. It looks like their fund went from 8 to 92 cents per share to 8 TCT cent per share to 8 3 per share. Remember, this is based on the last 6 months. This includes a December distribution of 0.535 share, making it about $0.50 per share. Remember, this is based on the last 6 months. This includes a December distribution of 0.2035 Tom 5 or 355 per share, making it about 0.43% return. What worked? They made good investments in materials, communications, and information technology sectors. Specifically, they called out these 5 securities because they resulted in positive performance: Goldfields, Anglo, Gold Ashanti, Datatec, MTN Group, and Naspers. It wasn't all sunshine. Industrial, healthcare, and consumer staples investments dragged down the portfolio and named the following companies: Aspen Pharmacare Holdings, Motus Holdings, Grindrod, Bidvest Group, and Sappi. Also hurting the fund, the South African rand depreciated a whopping 5.2% against the US dollar. Currency exchange is a complicated business. Now let's look at the fund's yearly performance. You have to remember that all funds may or may not be a sound investment, and it's a gamble. In 2015, a 10K investment resulted in a value of 10,530 later, of 10,000 baht a decade later, resulted in 13,530 in dollars. Like, it's not the best managed, but you can't win every time. Damru, 2% for the Africa Fund, 0.2% for the Africa Fund, 0.2% for the Africa Fund, 0.2% for the Africa Fund, 0.02% for the Africa Fund, 0.02% for the Africa Fund, 0.2% for the Africa Fund, 0.2% for the last 10 years as of April 2025 is 0.2% for the last 10 years as of April 2025 is Everate Vat 0.2% for the Africa Fund against 0.2 index and 3.02% for the best managed. What are they holding on to? Their primary holding is Capitec Bank Holdings at 13.3%. Next up, the Commonwealth Australia New Zealand Fund, so we can see how those investments did. The thing that stands out with this fund right away is that the costs are almost double the African fund to 2.296% or $144. They're down as well, with a reported decrease to 10.55 per share versus 11.06, and this represents a free 25% return. Come on the plus side, consumer discretionary, information technology, and communication services helped buoy the fund. Specific thanks go Millennium and Copthorne Hotels New Zealand, Marsden Maritime Holdings, Southport New Zealand, Marsden Maritime Holdings, Southport New Zealand, Marsden Maritime Holdings, Southport New Zealand, IGPS Group Limited, and Telstra Group. On the other hand, healthcare is really hurting, same as before. Additionally, the depreciation of both the New Zealand dollar and Australian dollar against the US dollar made it slightly worse. Let's look again at the yearly performance. You start with 10K in 2015, and in 1 decade you reach 16,012% of April 2025. Now compare the return rates for the last 10 years to its competitors, and this fund averages 4.83%. Its competitors, the Australian All Ordinaries Index, averages 7.04%. SC Dollar X USA index averages 4.83%. And the NZX 50 index 4.82%. And the NZX 50 index 4.82%. Its competitors, the Australian All Ordinaries index averages 7.04%. MSCI ACWX USA. In the NZX 50 index 4.82%. Its competitors, the Australian AXWX USA index averages 4.83%. And the NZX 50 index 4.82%. And going into the top holdings, their highest holding is in Southport, New Zealand at 11.5%. All right, now we are going to check out the Commonwealth Global Fund. This fund is an interesting mix, including everything that the prior two weren't. We see costs of only about $124 for each $10,000 invested. This fund is about the same as the ANZ fund, reported a 4.95% reduction and brings holdings to 19.116 per share versus $20 at T1 grew on last fall. Agro consumer discretionary, financials and utilities did positive here, and Japan, Norway, Germany, India and Switzerland were the geographic positives. The winners were reported as Sony Group Corp ADR, Siemens AG ADR, Group Panzerdige Forsikring ASA ADR, Group 1 Autovetting, HDFC Bank Limited ADR. What negatively impacted this fund were information technology, healthcare, industrials and energy sectors, and investments to the US, South Africa and Israel. The stocks that hurt the fund were attributed to Miller Industries Inc., Novo Nordisk, ASADR, NetApp Inc., Thermo Fisher Scientific Inc., and Skyworks Solutions Inc. Alright, let's see how the fund performed over the last decade. A $10,000 investment turned into $22.879 as of April 2025. Their average rate of return for the last 10 years is 2.64% versus the MSCI IT Net's 8.nets. Looking at the top holdings, it's what you expect with Apple leading the way at 6.1%. Let's go to the Commonwealth Japan Fund so we can compare with the prior report. This will be our last one with financial tables, so let's dig in. For every $10,000 invested, it cost about $89 to manage for this 6-month period. Of this fund's NAV increased, which is a nice change of pace, to $3.94.79. That represents a $4.5679 That represents a 4.566% return, including a small distribution. The gains here came from industrials, financials, and consumer discretionary sectors, with holdings in Kojima Corp, Sompo Holdings Inc. T, XTNCD Holdings Co. Limited, and Yame Group Holdings Co. Limited, giving the most bang for the buck. Currency appreciation with the Japanese yen also greatly helped this fund. Investments within sectors like healthcare, materials, and utilities didn't come up, and reported losses were attributable to Hoya Corp, Kansai Electric Power Co. Inc., Unicom Corp, Shinetsu Chemical Co. Limited, and Mitsubishi Gas Chemical. 10K invested in 2015 becomes 17,695 2025. But yearly comparisons show that the averages are below the main index. The fund returned 213% versus the Tokyo Stock Price Index is 5.87%. Looking at top 10 holdings, their top company is Kojima Corp at 4.7%. Our last fund we are looking at is the Commonwealth Real Estate Securities Fund. So let's get to it. It'll cost you $120.44 for each $10,000 invested after this net asset value went down. It's at 22.42 versus 24.71 from last year's report and equals 7.69% return. The gains that did occur were traced to the industrial sector and the leading companies, Grupo Aeroportuario, Del Shore Cest, ADR Kojima Corp, ADR, Technoglass Inc., Summit Materials Inc., and American Tower Corp. The fund suffered due to Iron Mountain Inc., James Hardie Industries, Plessey ADR, Lennar Corp, DR Horton Inc., and Arshay Sustainable Infrastructure, and these securities negatively impacted return. The performance from the last 10 years has seen a $10,000 investment reach a value of $1723.24. Compare this to its benchmark index, the Commonwealth made 4.89%, and MSCI US REIT index resulted in 5.65%. Their greatest holding is with Technoglass Inc. at 9.1%. The good news is both officers are saying they can safely form the basis of the certifications required. They report that the registrant's disclosure controls are effective. Okay, so what does this report really tell us? I want to summarize the points, say my opinion, and close the video. First, there's diversity in returns. Not every fund is a winner, and it's very clear that some of these funds are not performing very well and consistently losing to the broader market. Third, and second, management costs do matter. Higher fees eat into your returns, so it's essential to keep an eye on those. While it might not be the biggest portion of the pie, it does eat away from your return. Our third, sector and geographic allocations greatly influence performance depending on your appetite and available capital. Now, giving my opinion after seeing the raw numbers, I cannot say I am convinced with any of these Commonwealth funds. They look risky and might be a gimmick for an investment strategy that can be achieved using a generic fund. The largest red flag has to be outdoing their own index, which some of the funds struggle. But what do you think? Let me know in the comments, and don't forget to like and subscribe and join the Discord server for more in-depth explanations. Axon, thanks for watching. See you next time.